What if I told you a market crash is basically the stock market yelling, "Everything must go," and then everyone runs out of the store? Here's the truth. Crashes are when long-term wealth gets built because great assets go on sale and fear does the selling for you. In 2008, the S&P 500 fell about 50%. It felt like the world was ending. But the investors who kept buying during that mess did incredibly well in the decade that followed. In this episode, I'll show you 3 reasons smart investors love crashes and 3 simple systems you can set up before the next one so you don't panic sell at the worst possible time. And you'll walk away with a repeatable framework I call the crash playbook. Survive, deploy, select. First, let's get into the 3 reasons smart investors actually love crashes. Reason number 1. Crashes are discount events, not disasters. And before you think this is just motivational talk, let's make it concrete. When markets drop 30 to 50%, you're buying the same future cash flows at a cheaper price. If a quality index fund or a strong business is down 40%, that's not a bad deal, that's a price tag change. Think about it like this. If your favorite store had a 40% off sale, you wouldn't say, "I'll come back when prices go up." But investors do exactly that. In big downturns, people dump broad indexes and blue-chip companies even when the business still works. Apple doesn't stop selling iPhones because the S&P has a bad month. A strong business doesn't become worthless overnight. Fear just temporarily hijacks its pricing. Reason number 2. Most selling is forced, not smart. This is where crashes turn into wealth transfers. The biggest reason people lose in crashes isn't because they chose the wrong stock, it's because they become forced sellers. Forced selling happens when you don't have an emergency fund, you invested money you needed soon, you used too much leverage, or you lose income during a downturn and need cash fast. That's why crashes often move assets from people who can't hold them to people who can. If you have 3 to 6 months of expenses in an emergency fund, the odds of becoming a forced seller drop massively. Without that buffer, a job loss plus a falling market can trap you into selling at the bottom. And reason number 3, the crowd buys high and sells low, and it's biological. Even smart people do this. It's not an IQ problem, it's a nervous system problem. When your portfolio drops 20%, your brain doesn't interpret it as a temporary discount, it interprets it as danger, run. That's loss aversion and the fight or flight response. It helped your ancestors survive lions. It does not help your brokerage account survive the news cycle. The pattern is always the same. When markets are soaring, people feel safe, so they buy. When markets crash, people feel danger, so they sell. That's why the famous Buffett idea, "Be greedy when others are fearful," works. It's literally about doing the opposite of the emotional crowd. So how do you do that? Here's the framework you can repeat anytime markets get ugly. I call it the crash playbook. It has 3 buckets. Survive, which means having an emergency fund so you're never a forced seller. Deploy, which means using auto-invest and increasing your contributions. And select, which means having a watch list and valuation triggers ready. If you remember nothing else, remember this. Survive the crash. Deploy during the crash. Select what you're buying. Now, let's break down the 3 systems you can set up before a crash happens. System number 1 is to survive by building the forced seller firewall. If you do only one thing after this episode, do this. You cannot take advantage of a crash if you're financially cornered. A simple rule of thumb: have an emergency fund with 3 to 6 months of essential expenses. If your income is unstable, say you're freelance or work on commission, consider 6 to 12 months. And only invest money you won't need for at least 3 to 5 years, because stocks can be volatile short-term. This isn't the boring part. This is the cheat code. The people who win crashes usually aren't doing genius math, they just aren't forced to sell. System number 2 is to deploy by automating your buying, so your emotions don't get a vote. The best crash decision is the one you made before the crash. Set up automatic investing, also known as dollar cost averaging. For example, if you invest $200 every week and the market drops 30%, your $200 automatically buys more shares at cheaper prices without you needing courage in the moment. You can even upgrade this with a crash boost rule. In normal times, you invest your baseline amount. When the market is down 10%, you add a little more. When it's down 20%, you add even more if your budget allows. Even small increases matter. You're building a system where lower prices automatically turn into higher ownership. And yes, it feels emotionally wrong. That's why it works. System number 3 is to select by building a watch list and setting triggers. This is how you stop panic buying random stuff just because its price is red. Before any crash happens, build a watch list of things you'd happily own for years. For most people, this means broad market index funds like S&P 500 type funds, high-quality companies you understand, or diversified ETFs. Then add valuation triggers, simple rules that tell you when to act. Examples could be, I buy more of my index fund when the market is down 20%, or I only buy individual companies when they're down 30% or more and the business fundamentals still look intact. You could simply keep a list of 5 to 10 companies you would love to own at a discount. This is how a crash becomes Christmas morning instead of a panic spiral. Quick pause. If you want a one-page crash playbook checklist, subscribe to this podcast. I'll put a link to it in the show notes for this episode so you can save it and use it during the next downturn. Now, let's finish with the big objection. This is the question everyone asks. What if I buy and it keeps falling? 2 answers here. First answer, that's normal. Crashes don't drop in a straight line. They drop, they bounce, they drop again. That's why systems matter more than timing. Second answer, define what you're investing in. If you're investing in diversified, high-quality assets, the never recovers scenario is basically the entire economic system permanently breaks. And if that happens, your savings account isn't the superhero either. What is rational is risk management. Emergency fund first, no high-interest debt, no investing money you need soon, diversify, and avoid leverage you can't survive. That's how you stay in the game long enough for compounding to work. This brings me to the wealth transfer moment. This is the part most people miss. During crashes, assets often move from people who must sell to people who can buy. That's why crashes accelerate wealth transfer. You don't need to be rich to benefit. You just need a plan that prevents forced selling and allows consistent buying. That's why the crash playbook matters. Survive so you're not forced out, deploy automatically so fear doesn't stop you, and select wisely so you're not gambling. So, here's your simple today checklist. 1. Build or confirm your emergency fund. Aim for 3 to 6 months. 2. Turn on automatic investing, weekly or every payday. 3. Create a watch list, index funds plus a few companies you understand. 4. Pick your triggers, those down 10, 20, 30% rules you'll follow. And 5. Do a time horizon check. Don't invest money you'll need in the next 3 to 5 years. Do this in calm markets while your brain is logical, so when the next crash hits and emotions are screaming, you're just executing a plan. Market crashes will happen again. That's not a bug, it's a feature of markets. The question is whether you'll be the person selling the future at a discount or buying it. Remember the framework: survive, deploy, select. If this changed how you think, make sure you're subscribed, because in our next episode, we'll cover Financial Crisis Just Hit? This checklist saves you. That episode will help you decide exactly what to do before the next downturn hits. See you there.